Hello everybody, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video on Duke Energy, ticker symbol DUK. Duke Energy is currently up 8.89% over the past year. The market cap is 83.59 billion, the PE ratio is 19.88, and the stock currently has a dividend yield of 3.86% annually. The 52-week low for Duke Energy is $90.09, and the 52-week high for Duke Energy is $121.25. Analysts range in their ratings of Duke Energy. 9 analysts have Duke Energy as a buy, 1 has them as overweight, 11 has a hold, and 1 has an underweight selling, with an overall consensus of overweight on the stock. This is according to the Wall Street Journal. The stock price target for Duke ranges from a low of 117, a median of 121, and a high of 139. The current price is 107.71. Now, the earning estimate trends, currently, they're estimated to make $1.48 per share for quarter one of 2025. 1 month ago, that target was 149, and 3 months ago, that price target was 145. For the Q4 2024 estimate trends, the current is 168, 1 month ago was 168, and 3 months ago was 153. The following are the compound annual growth rates of the dividend for Duke Energy. This means this is the average amount that Duke Energy increased the dividend per that many years. For example, the 1-year dividend growth rate would be 1.98%. The dividend growth rate for 3 years, that compound annual growth rate is 2.01%, meaning that each year for 3 years, the average amount the dividend increased per year was 2.01%. The compound annual growth rate for 5 years is 2.03%. This is pretty much the same, slightly higher. But that means over the last 5 years, Duke Energy has raised the dividend by 2.03%. And the 10-year dividend compound annual growth rate is 2.77%, which means that for the last 10 years, on average, Duke Energy has raised the dividend 2.77%. Next, I'm going to be talking about Duke Energy's 3 core business segments: electric utilities and infrastructure, gas utilities and infrastructure, and commercial renewables. Electric utilities and infrastructure accounts for the majority of Duke Energy's revenue and income, operates regulated electric utilities serving 7.9 million retail customers across 6 states: North Carolina, South Carolina, Florida, Indiana, Ohio, and Kentucky. Owns and operates about 50,000 miles of transmission lines and over 300,000 miles of distribution lines, ensuring widespread service coverage. And what I have to say about this is that they are probably a good asset for, something that's inflation proof, because once these lines are down, I mean, they're super expensive to put down, but once you have them down, that's a huge part of your capex. So this could be a protection against inflation. Let's talk about Duke Energy's gas utilities and infrastructure. Duke operates natural gas distribution services in the Carolinas, Ohio, Tennessee, and Kentucky. Duke Energy provides services to over 1.6 million gas customers, including residential, commercial, and industrial sectors. ESG score is important to you when investing in an energy company. Then you should know that Duke Energy has their commercial renewables segment of their business. Duke is actually focused on unregulated energy operations, including solar, wind, and battery storage projects, where they have windmills or solar panels that charge up a battery that they can then give to their customers. Duke Energy operates renewable energy facilities with a total capacity exceeding 10 gigawatts spanning over 20 states. As you can see, year over year, Duke Energy has consistently grown their revenue. This is important because I think it highlights that Duke Energy is a very stable business that isn't going to have a lot of change year to year. And it also shows that, since 2020, Duke Energy has been able to consistently grow the revenue pretty much yearly. There's not a year on here where revenue is shrinking, and there's really not any inconsistencies. So that's something I really like for a dividend company, because that means that the dividend is probably safer if they're able to replicate the same performance over and over again. And the fact that they're raising it lower than some of the other, um, companies in the sector kind of shows that Duke Energy is a lot more conservative of an energy company, and that's why the market cap is so much bigger because it seems as though Duke Energy actually reinvests more into the infrastructure than a lot of other energy companies, and that allows them to have this higher revenue. And it means that you still get a good dividend, but it's not the crazy dividend that other companies offer. To start off the discounted cash flow model valuation of Duke Energy, I have the weighted average cost of capital here at 4.8%. You can see that the market cap is 50.96% of the value and the total debt is 49.04%. And with the costs of each and then multiplied by their weight, we get a weighted average cost of capital of 4.8%. Now, this valuation doesn't fully work for Duke Energy, and I'll tell you why in a second. Although I wanted to still run it in the same way. As you can see, the cash flows for Duke Energy have been negative, and the reasoning for this is that they're very high interest rates, and this is a very capital intensive business. Um, so you can see that over time, the free cash flow is probably going to continue to be negative, which is not good for the near term. Um, Obviously, it does take a lot of debt to operate in this space. And, I think Duke Energy is a stable company that's going to continue to grow revenues. But I don't know if this amount of growth justifies the amount of debt you're taking on for the company. So I might pass on this one just because I don't know when they're going to get free cash flows positive again, and I'm not going to try and speculate on when, certain rate cuts are there. But I think that they do have, just a ton of debt, and I'm just not comfortable touching that personally. Um, I know other people are more comfortable with companies that are really leveraged and have a bunch of debt, but negative cash flows are something that I'm just not comfortable taking on. Although I will say, this isn't investing advice. I'm not a financial advisor. I think that Duke may profit greatly from the new AI that's coming in because there's going to be a lot of demand for energy to power these AI training models and to just power AI in general. So overall, I'm very bullish on the company, the fundamentals of it, the fact that revenue is increasing pretty consistently. So, it could be possible for Duke to be able to get the free cash flows positive again. But what's going to need to happen is there's going to need to be a higher demand for energy. They're going to have to be able to refinance their debt for a lower amount. Um, and, eventually they just have to get these free cash flows positive. Once the free cash flow is positive, I'll feel a lot better investing into this. But until that happens, I just don't feel comfortable buying a company that has so much debt and, maybe close to getting the free cash flow positive, which, this could be undervalued, it could be overvalued. I just don't feel as though people should be buying this until they're able to make that free cash flow positive. And I don't really want to speculate on where I think the price should be when there are other energy companies that already have positive free cash flows that can operate the same way. Now, obviously, the difference here and the main reason you would really be entertaining a Duke Energy is the sheer market cap and the amount of size of the business. I think that's a very compelling thing for Duke Energy just in general. But I don't think a good growth rate is 25%. I think maybe it's something like 10%. And as you can see, that drives the price down. But yeah, I think if rates come down, Duke Energy could be a buy long term. And I think if you're someone who is a energy investor that wants a solid dividend that's reliable, you can buy into Duke Energy. But I think I'm going to be steering clear of it just because I think it's going to take a long time for them to be able to make the cash flow positive. And I don't like companies that take on a lot of debt personally, even if it's the optimal, cost mix for their capital and it allows them to do more projects. I'm more of a fan of getting companies that don't have a lot of debt and are just growing organically because right now, the current rate environment, I don't think is going to be very friendly in the near term. I think in the future, rates are going to eventually come down, but I think it matters especially for a company like this. It matters more with a company that has more debt, of course, because that means that if the rates are going to be higher, it means that they're going to have to pay more money in interest. So, for that reason, I'm not buying Duke Energy, but I think you should do your own research first. This is my stock analysis of Duke Energy. If you like the video, please leave a like, please subscribe. I really appreciate it. Bye.